Welcome back to the deep dive. If you're trying to cut through that mountain of corporate reporting, get straight to the strategy, well, you're in the right place. Earnings calls can be pretty dense, right? Technical, maybe a bit overwhelming sometimes.
Yeah, absolutely. And that's what we're here for. Today, we're doing a deep dive into Coca-Cola's Q3 2025 health check. Specifically, we've pulled out excerpts from the prepared remarks of John Murphy. He's the president and CFO.
Okay, so we're focusing just on his section.
Exactly. Strictly his numbers, his definitions, his outlook. We're really looking at the financial engine room of the company here.
Got it. So our mission today is to filter out all that noise, pull out the critical bits for you. What really drove their Q3? How did they manage to boost profits even with cost pressures? What's their balance sheet telling us? And maybe the most interesting part, what hints are they dropping about 2026 strategy?
Well, we've got three big takeaways from this material. First, how they managed to expand those operating margins, pretty impressive stuff. Second, the strategic shift they're signaling now that, big price hikes might be fading.
And the third.
A surprisingly positive currency forecast for next year. We'll definitely get into that.
Okay, sounds good. Let's start with that Q3 financial scorecard. What were the headline numbers the CFO laid out?
So the top line looks strong. Organic revenues grew 6%. And remember, that's stripping out currency effects and any M&A activity. Pure business growth.
2% organic and volume.
Unit cases.
Unit cases were up 1%.
Okay, 1% volume growth. That sounds a little light, maybe? But didn't the CFO add some context to that?
He did, yeah. It's important. He mentioned that while the quarter started a bit slower, the 2-year volume trends actually picked up each month. So sequential improvement.
So momentum built through the quarter. That makes sense.
Exactly. It signals some resilience in demand, even if the headline number is just 1%. Now, here's where it gets a bit tricky. You said 6% organic revenue growth, but only 1% volume growth. So that gap, that's all price mix. Maybe just quickly explain price mix for everyone.
Sure. It's basically the difference. Price is straightforward, raising the price tag. Mix is about what people are buying. Maybe switching to smaller, higher margin cans or buying more premium drinks.
Right. So how did that 6% break down?
Well, the CFO laid it out. About 4 points came from actual pricing actions, and the other 2 points came from that favorable mix shift.
4 points from price.
Mhm.
And the context there, we've seen huge price hikes across the board because of inflation.
Right, but here's the key phrase he used. The pricing pressure from intense inflation has, quote, largely abated. That's a really significant signal.
Largely abated. So suggesting maybe the era of really aggressive price increases is kind of winding down.
That seems to be the implication, yeah. They might not need to lean on price quite as heavily going forward.
Okay. And we should probably quickly mention that detail about concentrate sales. They lagged unit cases slightly.
Good point. Yeah, concentrate sales, what Coke sells to its bottlers, were up 5%, so 1 point behind unit cases. The CFO just put that down to the timing of shipments.
So more of a logistical thing, not a demand issue.
Seems that way. Nothing to suggest a problem there.
Okay, moving on from the top line. Let's talk profitability, because this is where, as you said, it gets pretty interesting. There's a bit of a contradiction in the margin story.
There absolutely is. So, get this. Comparable gross margin actually declined slightly, about 10 basis points down.
Whoa, hang on. Let's define that. Basis points, what are we talking about there?
Right, sorry. A basis point is just 0.01%. So 10 basis points is 0.1%. Tiny, but still, gross margin went down.
And a dip in gross margin usually means input costs are still biting, like sugar, aluminum, freight, that kind of thing.
Typically, yeah. It suggests those costs are maybe still rising a bit faster than they can manage through pricing or initial efficiencies right at that first level of profit.
So a bit of a squeeze there,
Yep.
but the operating margin story was completely different.
Totally different. That's the fascinating part. Comparable operating margin increased by 120 basis points. That's a 1.2% jump.
Wow. So they more than made up for the gross margin dip further down the P&L. How? What did the CFO say was driving that?
He put it down to a continued productivity mindset, which, can sound a bit like corporate speak.
Yeah, it translates to we cut costs, right? But did he give specifics? How do you find 120 basis points of operating margin in a quarter?
He did give some specifics. He highlighted 3 areas. 1, really prioritizing supply chain efficiencies. That's ongoing work. 2, improving the efficiency of their advertising spend.
Getting more bang for their buck on ads.
Exactly. And 3, just being, quote, prudent with the overall expense base. So general belt tightening.
Okay, supply chain, ad spend, general expenses. If you had to guess, Which of those typically gives the quickest boost? Getting 1.2% improvement in one quarter seems fast.
That's a good question. Supply chain changes are often, the heavier lifting long-term payoff. But optimizing ad spend, tweaking campaigns, negotiating media buys, that can sometimes yield quicker results when you need that operating leverage. It suggests they're firing on multiple cylinders, structural and variable costs.
And that operational strength, it flowed right down to the bottom line.
It did. Q3 comparable EPS earnings per share grew 6% to 82 cents, which is solid, especially when you consider the headwinds they were facing.
Right, there were headwinds. What were they again?
Significant ones. A 6% hit just from currency translation, plus higher net interest expense and a higher tax rate. So getting 6% EPS growth despite all that is pretty strong.
And what about the balance sheet, financial health?
Also looking very solid. Free cash flow hit $8.5 billion year to date, excluding one specific payment related to Fairlife. And their leverage ratio, net debt, is just 1.8 times EBITDA.
Okay, 1.8 times EBITDA. Break that down for us.
Yeah.
What does that number tell you?
It basically measures their debt level relative to their core earnings power. So 1.8 times means they could theoretically pay off all their net debt with less than 2 years of earnings. Crucially, that's below their own target range of 2.0 to 2.5 times.
Below target, so they have a lot of flexibility.
Exactly. Lots of capacity for investments, dividends, share buybacks, or even acquisitions if they wanted. Very healthy position.
Okay. Before we look forward, there was one other kind of unusual item in the update, that ongoing tax dispute with the IRS. It's a big number hanging out there.
It is, yeah.
Yeah.
A long-running issue. But the CFO gave a specific and actually quite positive-sounding update. It's about royalties from their Brazilian operations that were blocked by Brazilian law.
And the update?
He pointed to a recent court decision involving 3M. Apparently, that case addressed the same underlying tax regulation.
And Coke thinks that 3M ruling helps their case.
That's what he said. He described the 3M decision as highly supportive of their position and reaffirmed that they'll vigorously defend themselves.
How much weight does an external court ruling like that really carry for their specific case? Does it actually reduce the risk much?
It certainly gives them a stronger legal argument, a precedent to point to.
Yeah.
It doesn't make the problem disappear overnight, but it's clearly boosted their confidence enough to mention it specifically in the prepared remarks. Seems to reinforce their stance.
Right. Okay, speaking of confidence, let's talk guidance. Did the CFO confirm they're still on track for the full year 2025?
Yes, absolutely. Full confirmation. They're reiterating their targets, which align with their long-term growth goals.
And those targets are?
Still expecting organic revenue growth of 5% to 6% for the full year and comparable currency-neutral EPS growth. So stripping out currency effects, still pegged around 8%.
But that currency impact, it's still a major factor this year, isn't it?
Oh, huge. For the full year, they expect currency to knock 1 to 2 points off net revenue growth and a really hefty 5 points off that comparable EPS growth.
5 points off the bottom line just from exchange rates.
Wow, it's massive. It shows the challenge of being such a global company. They also slightly updated their expected tax rate to 20.7%. So when you factor everything in, including those big headwinds, the expected all-in comparable EPS growth for the year is about 3%.
Okay, 3% all-in growth. And did the CFO give any specific flags or warnings for the fourth quarter?
Just two things could be in mind for Q4. First, they're up against a tougher comparison period from last year in terms of volume, especially in key markets, so growth might look a bit harder.
Makes sense. Law of large numbers.
Right. And second, just a calendar quirk. Q4 this year has one extra reporting day compared to last year, which gives a slight structural lift. Oh, and they confirmed free cash flow guidance, at least $9.8 billion for the full year, again excluding that Fairlife payment.
Okay, so Q4 has some puts and takes. Let's pivot now to the future. The CFO gave some early thoughts on 2026. What's the first structural thing people need to be aware of?
The calendar again. 2026 has its own quirks. There's a shift that means Q1 will have 6 extra operating days compared to 2025, but Q4 will have 6 fewer.
So that's going to make year-over-year quarterly comparisons tricky next year. You really have to adjust for those days.
Exactly. It significantly impacts the cadence of results through the year.
Okay, calendar noted. But the really interesting bit is the strategic shift, right? Especially now that he's saying that heavy reliance on pricing is likely over. What's the new focus?
The key phrase was shifting back towards balanced top-line growth. And crucially, he explicitly called out volume as a key priority going forward.
Volume as a priority. So less about just hiking prices, more about selling more stuff.
Pretty much. As inflation eases, You can't just rely on price increases to drive all your revenue growth. You need more people buying your products.
But how do you drive volume and still maintain strong revenue if you're not raising prices as much? What's the plan there?
It sounds like a two-pronged approach. He talked about leaning into both affordability and premiumization, tailoring it market by market.
Affordability and premiumization at the same time.
Yeah, sounds like it. So offering value options, maybe multi-packs or certain package sizes, in markets where consumers are stretched. But also pushing higher margin, more premium offerings, think specialized flavors, premium packaging where consumers are willing and able to pay more.
Interesting. Sort of segmenting the market more deliberately.
Seems that way, trying to capture growth at both ends of the spectrum, depending on local conditions.
What about costs heading into 2026? Is inflation still a worry?
He sounded relatively calm about it. He acknowledged cost inflation is still expected, but believes it's manageable. He did add a caveat, though. The system is still exposed to general volatility, trade issues, things that could cause bumps in specific markets.
So supply chain efficiency still needs to be a major focus then.
Absolutely. That productivity mindset isn't going away.
Okay, now for what you flagged earlier, the potential surprise in the outlook. After battling huge currency headwinds this year, what's the forecast for 2026 currency impact?
Yeah, this was quite the reveal. Based on current exchange rates and their hedging positions, the CFO actually expects currency to be a slight tailwind next year.
A tailwind after a 5-point headwind on EPS this year.
Exactly. A slight positive boost expected for both comparable net revenues and comparable EPS in 2026. That's a massive swing from this year's environment, potentially a really significant factor for the reported results next year.
Wow, okay. That's definitely something to watch. So wrapping up the CFO's message then.
I think the overarching takeaway is confidence. Confidence in hitting the 2025 numbers, powered by that operational execution we talked about. And confidence in their plan to navigate this shift towards more volume-led growth in 2026, even with lingering volatility.
And for you, the listener, probably the most valuable insight from digging into these remarks is really seeing that operational agility in action. I mean, boosting operating margin by 120 basis points when gross margin actually fell slightly, that really showcases how a big company can use internal leverage productivity, efficiency to counteract external pressures.
It's a classic example of strong management execution.
Definitely. So as we look ahead to that strategic shift in 2026, here's our final thought for you to consider. Given that they expect pricing to normalize less lift from just raising prices, how effectively can they really pull off that dual strategy of pushing both affordability and premiumization to keep revenue growing strongly while also hitting those newly prioritized volume targets?
That feels like the real balancing act for them and probably for much of the beverage industry heading into next year.
Absolutely. A tightrope walk indeed. We'll have to see how they navigate it.